Without further ado, I would start with the first panel. Mark told us of the importance of understanding data and making the difference between perception and reality. The next panel is about setting the scene. So I would invite to the stage John Buffes, a senior agricultural economist at Development Economics Prospects Group of the World Bank. There, please. Peter Havlik, Program Director at International Institute for Applied Systems, and Tassos Saniotis, Special Advisor for Sustainable Productivity at the Forum for the Future of Agriculture. I would start with the presentation. We have 3 presentations, 20 minutes each, more or less. I would invite John Buffes to start his presentation. Please go to the lecturer. If we can give a headline to this first panel, it could be food inflation. Is this time different? So let's start delving into data and knowledge with John Buffes. Thanks.
Okay. Good afternoon, everybody. First, a lot of thanks to the Forum for the Future of Agriculture, which invited me to make this presentation. And I promise you I will give you a lot of numbers, don't worry about that. Let me begin the presentation by just outlining the subjects, the 3 subjects that I'm going to cover. First, I'm going to talk about the current market conditions for agricultural and energy markets. This portion of the presentation comes mainly from a report that we published recently in the World Bank, namely Commodity Markets Outlook. It was published on October 29th, so very fresh information from that. This is a report that we publish twice a year, and many thanks to a lot of my colleagues that did a lot of work to put this report together. The second part of the presentation is going to look at the food and energy prices and how they relate to inflationary pressures for the past 2 to 3 years. And lastly, I'm going to talk a bit about long-term trends of commodity price and what we expect down the road, especially in relation to geopolitical issues and inflationary pressures. As I promised, I will start with some data. Here we see a long, so to speak, term price series on agricultural commodities, energy commodities, and metal commodities, just to give you an idea of how those 3 groups have behaved throughout the past 6 years. 2 messages that come out of this price chart is that prior to the pandemic, we had a relative stability, so to speak, across most commodity markets, not all commodity markets, prices, and this relative stability extends back to 2014 or 2015. Even if we go a bit earlier, we do see the same relative stability. And then we enter a period of quite high volatility, with prices declining in the early stages of the pandemic, then post-pandemic pick up, followed by a number of other events that took place in the world, namely the Russia's invasion to Ukraine, which disrupted energy and agricultural markets, and later on the conflict in the Middle East. So we had this high volatile period, and it appears that for the past 2 years, beginning in the first quarter of 2023, again prices have started entering a new level of stability. That's the first message, but the second message is also important to note that the level of prices now is higher than what it used to be prior to the pandemic. Depending on the commodity, this is about 20 to 40% higher. If we take into account the fact that we had some inflation between then and now, we're probably looking at prices that on average are 20% higher now than when they were prior to the pandemic in the real terms. And of course, that's the most important aspect that matters from the consumer's perspective. Just to look at what the crop conditions are doing recently with this year and this season and the previous season compared to history, we have put together grains in the chart to the left and edible oils in the chart to the right. And with the bars, we are showing how much growth has taken place for each season, and we compare that to the long-term 30-year average, which is the red dotted line. This is the 30-year average, and what we see is that the season that ended last summer, which is the penultimate line, or the second line from the right, was very good compared to history, above average in both grains and edible oils. The current season, which just started this summer, it's not as good as the last season, and that's why perhaps we have seen some pickup in prices lately, a little volatility. But there's still, the crop this season is expected to be on the positive side, but again, as I said, not as much as it was last season. Another way to look at the global food markets is to look at the level of inventories, how much inventories we have relative to consumption, and for the jargon of agricultural economists, is the so-called stock-to-use ratio. To the left, we are showing the three most important commodities, maize, rice, and wheat, but on the right, what we have done is we have aggregated 12 commodities, put them into one basket, so to speak, to see how inventories have moved recently compared to history. And what we see that inventories have come down consistently for the past 5 or 6 seasons, from a high of 31% to 26 or 27%, which is the current estimate. And of course, that has caused some tightness, so to speak, in those global markets for the last few seasons. But when we compare that to what happened back in 2007, 2008, and 2010, and 2011, we see that market conditions now are much more comfortable compared to then, which is the good news, I would say. Now let me move to energy, which is very important for agriculture for a number of reasons. Agriculture uses both fuel as an input, fertilizers through the natural gas channel, and also biofuels, depending on the energy prices. A lot of countries set the biofuels mandate. To the left, we see oil prices, which have been quite volatile recently, but for the past couple of years, or a year and a half, I would say, they have been fluctuating around $75, $80 per barrel, a little higher than pre-pandemic. The most interesting fact, or chart rather, in terms of the European agricultural and the European economy in general, is the middle chart. We see what happened in natural gas prices. They skyrocketed right after Russia's invasion to Ukraine. They have come down now, but it's important to note that both the European prices, which are influenced a lot by liquefied natural gas, and the LNG, the liquefied natural gas prices, which are influenced a lot by what the developments that transpire in East Asia, which is the most important the most important consumer, or LNG, those prices have still stayed at higher levels, depending on the math, etc., between 50% and 100% above what they had been prior to the pandemic. In contrast to the American natural gas prices, which are even lower in some months than what they had been prior to the pandemic. This is an important point for the European agricultural sector, and especially fertilizer sector, that places this region into what I would say a competitive disadvantage, so to speak. And to the right, we see coal prices. Important to know that coal prices can move a lot with natural gas prices, simply because both of them are used to a large extent for energy power generation, especially in East Asian countries, including China. Just one slide in terms of crude oil production. We see that a lot of production has come out from the United States in the chart to the left. That's one important message from this chart. And from the chart to the right, what we see is that Russia's crude oil production has been quite constant, I would say. There has been quite volatile, but Russia exports pretty much as much oil now as it did prior to the sanctions, I would say. Lastly, the slide that, of course, is of great interest to Europe is the natural gas inventories. In Europe, in the chart to the left, what we see is that the gray area represents the variability of natural gas inventories in Europe on average throughout the 2017 to 2021 period, which was fluctuated quite a lot. But after the shortage of supplies of natural gas in Europe, what we see is that a lot of pipeline that was gas that was coming from Russia has been replaced by LNG, and both last year and this year inventories have been at extremely high levels, which is good news, but of course that means they pay higher prices, which is the bad news. And to the chart of the right, what we see is that initially a lot of the LNG was directed from East Asia to the European markets in 2022 and 2023, but now some of it goes back to Asian, and we have according to some reports, more Russian natural gas coming to Europe, as well as natural gas supplies from the Middle East are coming to Europe. Just to give you an idea of what our forecast doing, prices we forecast in the report, the most important numbers are the middle column to the second panel, which we show the percent change from the previous year. What is headed as 2025F, that means forecast. And what we see there for the next year is pretty much weakening of prices across the board, from energy, agriculture, and you see basically a lot of minus signs there, which, as I said earlier, that reflects for the most part that energy supplies, we have good supplies on the energy side, and on the agricultural side, some tightness, but not as bad. So that's why we expect a lot of declines for next year. Moving to the second part, the food price, energy, and inflationary pressures. Just to set the stage, I have separated here food price inflation from core, headline, which is the whole thing, and food price inflation to the right. And a couple of important messages that come out of here is that what we see this time is that food price inflation led the way, and energy price inflation, which we do not show here. So that's one important message. And the second important message that when we compare the European Union with the euro area with the US, we see that the euro area had much more of an inflationary pressure issues compared to the United States. This bell-shaped curve, it's not only relevant, applicable rather for the United States and European countries, but when we look at a much larger sample of countries which include both advanced economies as well as emerging market and developing economies, another name for developing countries, we see that prices went up pretty much. They are down now. I'm sorry, inflation went up. It's down now. But food price inflation pretty much led the way everywhere in the world. Now, food price inflation, price inflation in general, food price inflation has come down now, but it's not there to the levels that the central banks would like to have. It's very important, and I would like to stress this point in my presentation and throughout the conference, that when we look at price inflation, you have two kinds of issues there. One issue is that how price inflation is looked by the central bank perspective, which is the rate. We compare the rate this year with the rate last year, and that's important from stabilization issues from the central bank perspective. But it's the other side of how much prices went up in levels, and that's what happens in consumers' pockets. Because for the most part, central banks claim for the right, for good reasons, that they have sort of won, so to speak, or almost won the fight against inflation, but this is not how consumers feel or how consumers vote in some countries. So just here to show is that we have core inflation and food price inflation, and no matter at what level you look at, you get the same picture. Here in this chart, I'm showing the food expenditures the food price inflation for the G20. And again, here it's very important. I'm showing the level of the fourth quarter of 2020 compared to the fourth quarter of 2023. So we're talking about 3 years. And this is the change that we have seen. So in the median, we have seen about 23, let's call it 24% change, which when we divide it by 3, consistently on average across the G20 countries, we have seen an 8% food price inflation. And again, that's the G20. When we move to emerging market and developing economies, this number is much higher. It's important to note that, as I said earlier, we also look at the level. And here I'm trying to compare the food price index, the index that I showed you earlier on in my presentation, which I showed you the agricultural price index, but it's very similar to the food price index, which I also showed here. And we compare that with the global inflation index, which is produced by the FAO. And both, again, I emphasize it, those are levels, not the differences I have been showing you in earlier slides. And what we see here that while the food price index has come down this the World Bank Food Price Index has come down quite a bit since its peak last year. This is not the case for the food price inflation, but let me also mention the fact that this food price inflation, the red line, which is monitored by the FAO, it's 6 months old, so it doesn't really capture the decline that we have experienced recently. And it also includes all countries, which includes some hyperinflation countries, which also boost it upwards. Last point on energy prices. What happened recently, especially in Europe and globally, I would say, is that the biggest shock came not from oil prices. It came from other energy sources, including LNG, natural gas prices, as well as coal prices. And what I'm showing here is the difference between oil prices and an energy index which combines all three components. And by the way, for some, to give you some more details, in this price index, the energy price index, we have used consumption weights, which means that pretty much it's 1/3 crude oil, 1/3 natural gas, and 1/3 coal. It's basically what people consume. And it's important to see the effect of energy prices, especially in this recent boom, where we see energy prices went up by magnitude, by quite a bit compared to oil. The reason I'm stretching is that most economists, we tend to focus on oil, but in fact, it's the other two commodities that matter most. My last part, I just wanted to look at some long-term trends. This is a bit more research and heavy, research-oriented piece. I'll do my best to explain what I mean here. Those are the three the three indices: energy, agriculture, and fertilizers. In fact, I have taken data here, annual data since 1960. And what is important here to kind of see is that you have different kind of trends in the different commodities. When you look at energy prices were very low. They went through a boom, relative stability, and another boom. So if you wanted to summarize price trends for energy, they have been increasing. Now, when we look at fertilizer for the most part follows energy prices, especially recently. And that's because they can move a lot with natural gas and to some extent in coal. It's important to know that most of the world makes fertilizers out of natural gas, but China makes fertilizer out of coal. That's why we also have this movement there. So when you look at agriculture, we had a declining trend, but in the 3 decades after the 1960, and that has, I would say, even reversed or stabilized, depending on how you explain it. So what we wanted to do here is to see how much of this long-term trend explains commodity market, commodity prices, and what is due to short-term price variability. This gets a bit heavy here in terms of the analysis we have done in the econometric analysis that has gone behind it. But what I would like to point your attention is that when we look at the agricultural commodities, what I call it annual agriculture to the left, you see a very large green bar, and that indicates that agricultural commodities, food commodities, they are they are driven for the most part by long-term trends, not short-term variability. When you look at energy and metals prices and other kinds of prices to the right, what you see is that those prices are determined more by medium-term cycles and shorter-term variability. And this is not surprising for the following reason. Pretty much agriculture and especially food prices follow that growth in those commodities follow, for the most part, population growth trends. But when you look at other prices, especially metals and energy, they follow mostly income growth trends, and income is much more volatile than population growth. But the takeaway is that agriculture is characterized by the long-term trend component very much. So when we decompose that, after we did the decomposition, we also are showing here, okay, how those long-term trends look. And again, by taking into account the fact that for agriculture, the long-term trend is more dominant, while it's less dominant in other commodities. And what we see is for energy, it has been going up, not surprising. Energy is a non-renewable commodity for the most part. Whatever you extract, you have less in the ground, subject to technological improvements. Agriculture is a renewable commodity, it's not subject to the same trends, but it's very clear for the lower two lines. Unfortunately, they're both green, but the one is annual agriculture and one is perennial agriculture, like trees, coffee, cocoa, etc. What we see is that we had this decline that lasted until about 20 years ago, but now we have a reversal on this. A number of explanations for this, which I'm not going to get into those now. The same trend that I showed you earlier in the decomposition applies throughout a number of commodities. When we look at the industrial commodities, we see that this is dominated by the yellow bar, which is a cyclical part, while when we look at agricultural and food commodities or agricultural other commodities, this is dominated by the gray bar, which is the long-term bar. Again, the same result that applies throughout the entire commodity spectrum, not just in the price indices that I showed you earlier. With that chart, I would like to end my presentation. Just let you know that most of the material that I presented here, it's either published in the Commodity Markets Outlook, which is the report to the left, or it has been published in research papers, which are in the public domain, and I'll be happy to share them with you. All our material is accessible free online, including the Commodity Markets Outlook. To the right, we have the price data sheet, which is probably the World Bank's earliest, oldest publication, has been published, I believe, since the mid-1960s. Once a month, we publish it in the second business day of the month. And in the middle, we have a number of, I'm showing one blog. After we publish the publication, we also publish blogs that summarize the key findings of the report, as well as updates that have taken between the time of the report and the time of the publication of the blog. Thank you. Wow.
Thanks to John Duchess.